community bankers are nothing if not resourceful, right? We've seen plenty of examples of that.
Well, welcome back. We've been talking about community heroes throughout this series, and I want to highlight, last week's we talked with John Oxford, and we talked all things bank marketing in Tupelo, Mississippi, which was a wonderful time. This week, we have a new guest. I was able to sit down with Jim Reber, who is the CEO of ICBA Securities. And really, Jim is the guy that every community bank CFO needs to have on their short dial. Jim has a phenomenal background and experience, as you're going to see, about the financial investments you need to be making to make your bank as profitable as possible. This past year, with increases in deposits and a change in the landscape economically, I thought it was really a timely situation to get to sit down with Jim and hear some of his background and advice for anyone in this kind of role. With that, I'd like to welcome Jim Reber. All right, Jim. How you doing?
Doing great.
All right, good. So, Jim, I'd love to talk a little bit about this last year and everything that's kind of gone on. But first things first, let's talk a little bit about how you ended up working for ICBA and representing the securities division. How did you end up here?
Accountant by trade, bond salesman for Vining Sparks for 15 years. And the legendary C.J. Pickering, who was the first president of ICBA Securities, reached retirement age in 2005, and I was asked to succeed him. I was very flattered by that, and still not sure why the founder and owner and CEO of Vining Sparks picked me to succeed C.J. Pickering, but again, it was very flattering to do so. And so I took over an organization that was up and running. A lot of people said to me, "You got big shoes to fill." Well, that was quite obvious. I did, but I realized that I wanted big shoes to fill. I didn't want to come into something that was broken, and so I really just tried to put my stamp on the organization for the last 15 years and keep it going. And between all of the support that Vining Sparks gives to ICBA Securities, ICBA's good name amongst the community bankers of the country, it's been a win-win situation for, I think, everybody, and that includes the customers of Vining Sparks.
Right, and so you've been able to really connect in an intimate way with banks, right? Mm-hmm. When we think about the relationship that you have with your clients, it's at an extremely intimate level because we're talking about the capitalization of banks across the country.
Well, and it's repeat business too. I mean, we're not the type of organization, we're not an auto dealer where you buy a car and you don't think about buying a car again for 5 years.
Right.
You buy a bond from your brokers, on an ongoing basis. So you have a constant dialogue with these people, and you get to become very knowledgeable about them. In many cases, you become personal friends with them. That's been something very gratifying for me. I've been able to make some lifetime friends out of this role that I've been playing here. Our board of directors are made up of just terrific landmark leadership bankers, and my wife and I have been able to become good friends with a lot of them. That's very, very rewarding to me. So yeah, it's good stuff. And this is an important part of the banking management puzzle too. Somewhere around a third of a bank's assets are investments.
Mm-hmm.
They'd rather have less investments and more loans on balance, but the math says about 1/3 of banking assets are the type of investments that we sell. So it's a significant driver of a bank's success, is how their bond portfolio performs.
Now, when we think about this last year, market turmoil, obviously some increased capitalization for a lot of banks as well. What was your role in really helping properly manage those funds within banks?
Okay, well, we of course had no better idea than anybody else did that we were about to get into this pandemic,
Right.
and all of the implications that has, all the ramifications that took place. But I really see it was like several different phases that banks went through. Almost exactly a year ago, at the beginning of March, the Federal Reserve called an emergency meeting. They cut rates, overnight rates, to zero. Interest rates across the curve fell. Banks got deluged with cash because not only did some of their assets prepay on them when rates fell, but also there was a lot of flight to quality, and depositors in many cases cut and ran from the stock market and went into the safety of community banks. So banks were deluged with cash. In very short order, here comes the first round of PPP. So they had to get really busy about getting the PPP loans funded. And then they kind of came up for air sometime in the springtime and said, okay, I'm sitting on all this cash. Yields are near zero. I don't have any organic loan demand. What do I buy? So we helped them, I believe, make good decisions on how to deploy all this excess cash and keep their margins semi-respectable and sort of help them to live for another day. And we're not really out of that phase yet. So we're continuing to analyze a given bank's risk-reward profiles and needs, and continue to make recommendations to them that we think are going to be in their best interest.
Well, now I respect that last year you didn't see it all coming. No one did, right? But through this time, you started adjusting, a lot of those things and preparing for kind of what's next in the bond market, as well as we're seeing a slight uptick in some rates. How's that affecting the bond market for you?
Well, it's the brokers are more happy today to be calling their clients to say, here's what kind of yield I can get for you today.
Right.
Okay. Now that's not an across the curve jump in rates though, because I think we all have seen that longer rates have gone up in anticipation of inflation.
Right.
We'll see if that actually happens or not. At the same time, the Fed is saying, I understand why longer rates are higher, and that doesn't really scare us, but we're going to keep shorter rates low, and guess what? We're going to keep shorter rates low until 2023. At least that's what they've told us last. So we could be in something of a range now. We could be sort of in a range-bound interest rate environment, and that's going to make it punitive for banks to not be invested. It's going to be very costly for them to sit on uninvested cash, but it also has given them some reward for actually doing some investing out as we say, out on the curve. Maybe a little longer duration investments than normally they would do. Now, to help satisfy our customers that they're not selling the store, we are constantly monitoring what their risk profiles are, and in bond world that means what your average duration is. So we try very hard to keep our eyes on how long this collection of investments is likely to be out there, so we don't overload the boat, as it were, on overly long investments. And I'm happy to tell you that today the average bank's duration is no different than it was a year ago. So bankers have been very mindful of this. I'm very impressed with how they've kind of managed this whole set of dynamics on the fly, and I think that they're well positioned for interest rates as they are now situated for what looks like at least some part of 2021.
Now, obviously, one of the primary concerns in the bond market has been the Fed's impact on the bond market, and especially as we look at where we're positioned today, it seems like they're a little bit less concerned about interest rates in the short term, right?
And their reasoning is pretty consistent. Some would say it's sound. I'm not going to comment if it's sound or not, but if nothing else, it's consistent. All the Fed members that are speaking are really saying the same thing. They don't think that inflation is yet going to take root, and they're really interested in getting prices not just stabilized, but actually up a little bit. And that's, really in everybody's best interest to have a little bit of inflation. I mean, I've heard it said that Thomas Jefferson was quoted as saying, a little revolution is a good thing. well, a little inflation is a good thing, and it running under 2%, the Fed thinks is not where it wants to be. So it's going to keep its foot on the gas pedal, and if it overshoots its inflation target, which is 2%, up into the mid twos, I believe I've heard several of the Fed board members say that, then they're going to live with those consequences because they don't think it's going to take root and stay long term like that. So, their dual mandate, is to maximize employment and price stability. They don't like what they're seeing out of either one of those right now. There's a whole lot of millions of people that are on unemployment assistance, and that unemployment rate is 6 something now. It was 3 something a year ago. So they think that their charge requires them to keep a lid on interest rates for the time being, and they've got the ability to do that. They have got plenty of money that they can still bring, plenty of tools they can bring to play to affect what interest rates are going to be for the near future.
Well, it's been a phenomenal year to watch the markets and to try to interpret what's happening. Obviously, the Fed's impact has been unprecedented, but as we think about the next steps, if I'm a CFO of a community bank and I'm relatively well capitalized bank in 2021. What should I be thinking about?
Well, this sounds self-serving coming from somebody in the broker-dealer industry, but it's going to remain just prohibitively expensive to not stay invested somehow. I mean, overnight rates literally yield 8 basis points, okay? Banks' cost of funds, anecdotally, they're running from 30 basis points to 60 basis points. So if you're not at least covering your cost of funds, you're literally losing money, okay?
Right.
So I think what our customers, our portfolio managers that we've had some very, very close discussions with, the ones that we're most familiar with, are kind of dawning on them. They need to keep staying invested, and if this economy finally does get back to where it was a year ago, then they are seemingly going to have enough liquidity on hand from their bond portfolios to pretty quickly be able to convert that into what they prefer, which is good quality loans. So the theme is stay invested, keep your eyes on your duration, and try to manage your margins the best you can under these difficult circumstances. Always glad to report that credit quality seems to have held in there very well too. I mean, banks reserved themselves pretty aggressively in the first half of 2020. In many cases, banks actually reduced their reserves in the second half of 2020, and bank earnings seem to be poised to do pretty well in 2021, even with the compressed margins. So this looks like a collectively an industry that's very well policing itself.
Right. Well, and particularly in the community banking space, where we've seen some additional fee income from some other programs, obviously, which it seems like a lot are deploying that in a very healthy way as well.
Yeah, community bankers are nothing if not resourceful, right?
Right.
We've seen plenty of examples of that. Drilling down a little bit into the bond portfolios, they look a lot different now than they did 2-3 years ago. There's different municipal type products out there that banks are investing in, including what we call general market munis, including taxable munis. There are different types of mortgage securities that the broker-dealer industry is creating in the origination process, in the underwriting process that bankers have taught themselves about. And so again, between keeping a lid on what their risk profiles are and in many cases taking some stabs at some relatively new products which may be suitable for a bank, may not be, I'm again still really impressed with how banks are on the fly, sort of reinventing how they buy their bonds and manage their balance sheets.
Right, and you're sort of thinking the 3-year sort of time frame is that relatively short time frame?
Yeah, and 3 years is sort of in the back of broker dealers' minds, because the average bank's investment collection will turn over in about a 3-year period. So and as a result of that, I think bankers themselves think out into about about a 3-year horizon, and so that's not a prediction where rates will be in about 3 years, but I just know that mentally banks sort of manage their balance sheets sort of over the next 3 years.
Yeah, and obviously if we do see some increased inflation in that time period, then maybe reallocating some of those funds might be a good strategy.
Long term, that would be healthy for the industry because that would mean banks would make more money. The
Right.
margins would be healthier, and presumably the very reason that rates are rising is that the economy is expanding, which means that credit quality shouldn't be an issue. I mean, all things remaining equal, banks want an overnight rate of 3% and a prime rate of 6, and all that. So we haven't seen much of that in the last 15 years, to be sure. So if that were to happen, banks would, in short order, adjust their balance sheets accordingly and enjoy the larger margins that they have today.
Well, I appreciate the work you've been doing in this last year to really help secure a lot of the opportunities, really, as we look at what banking looks like in the next 2 or 3 years, right? Thinking through that time period and thinking, we may need some additional capitalization for new opportunities. And I think, being able to really support communities across the country, ICBA in particular, the work you're doing with ICBA Securities is phenomenal work.
Well, ICBA gets us in a lot of places. Between their own name, their own education platform, CBU, between the network of state associations that are affiliated with ICBA, we get out in front of a lot of bankers over, in a year's cycle. So that's afforded us the opportunity to give people our thoughts, and bankers have been interested in what their brokers are thinking. So we feel very good about having had the podium, as it were, to tell people what we're thinking. And I'm very proud of them for how they've responded to all these challenges.
Yeah. Well, Jim, thanks for being with me today here in Memphis. It's fun to be at the center of, as Barrett Banking School, we're co-opting their office today as they talk about banking, blues, and barbecues.
Right.
It looks like we're about to embark on some barbecue.
I didn't know how public we were going to make that, Ben, but now we've made that quite public. So very glad for that opportunity as well.
Yeah.
So, always a pleasure. Thank you.
Thanks, Jim.